This class topic is dissolution of partnership form when one of the partner become insolvent. Closing the books of accounts on dissolution of partnership form using Garner versus Murray principle. The dissolution problem to be solved using Garner versus Murray principle. This principle focused on capital account of both the solvent and insolvent partners. This does not affect realization account, and realization account is prepared as usual. When partners becomes insolvent and unable to bring cash amount equal to his debit balance of capital, either partly or fully, then the debit balance of his capital amount represent loss, and existing partners bear this capital loss in their capital ratio, not in profit sharing ratio, as it is not a trading loss. Again, capital accounts maintained by partners, whether fixed capital or fluctuating capital. In this problem, there is no current account given, hence, their type of capital maintained is fluctuating capital, and the capital ratio is calculated. Capital ratio is calculated after adjusting profit and loss account balance with opening capital balance, general reserve balance, but before adjusting loss from realization account. Closing the books of accounts on dissolution of partnership form using Garner versus Murray principle. Therefore, you are going to learn about principles of Garner versus Murray, what accounting treatments are suggested by principle when this principle is applicable. All these things I am going to discuss in this class with the help of one problem, and the problem is on the screen. Well viewers, so before starting the solution to this problem, so my request to you all, please like, subscribe and share with your friends. Do not forget to subscribe this channel, and one more important thing, that you must give your comments, and your comments, your suggestion is important for me. Okay, so let's see the question and the solutions on the screen. So step by steps I am going to explain you. In this regard, one more important thing, that about the dissolutions problem, recently I had already uploaded one video. So before watching this video, you must watch that video also. Video class recorded, and it is already uploaded, and it will be easier for you to understand this problem. And this problem is basically based on Garner versus Murray principle using while solving the problem of dissolution, and a partner became insolvent. Okay, so let's go. X, Y and Z are partners in a firm sharing profit and losses in the ratio of 5:3:2. Following is the balance sheet of the firm 31st March 2024. So capital account, credit balance of partner X and credit balance of partner Y, but Z has the debit balance 1 lakh rupees. And other informations like a reserve, it is a creditors, bills payable, Y is loan account. why he has given the loan amount to partnership firm, rupees 85,000. Then goodwill, land and building, asset, plant and machinery, furniture, debtors, provision 5,000, debtors balance 2,50,000 minus 5,000, so 2,45,000, and other stock balance is 80,000. Furniture 1,20,000. Cash at bank balance 9. Now, what are the additional informations are given? On this date, they decided to dissolve the partnership. The assets were realized as follows. So, by selling of land and building, 4 lakh rupees realized, plant and machinery 1 lakh rupees 20,000 received, furniture sold rupees 80,000, debtors, from the debtors 80% only realized of book value. The stock was taken over by creditors at an agreed price of rupees 70,000, partly paid by stock and partly paid in cash. Outstanding expenses not recorded 15,000 was paid 10,000 in full settlement. One liability amount, so not recorded in the books of account 15,000. Later on the amount paid 10,000 in full settlement. So only 10,000 and transactions value will be recorded. Expenses on a real dissolutions amounted to rupees 12,000, debit side. It was a certain that Jed becomes insolvent, and 30 pies, that is 30% of his debit balance amount is realized from his private property, rupees from his estate. That's one. So now what are the accounts we have to prepare? Realization account, partners capital account, and bank account. Here it is said apply Garner versus Murray. Now say the realizations accounts is be prepared by taking the assets and liabilities information. So here is on the screen realizations account, how it is prepared. Now on the debit side, as usual, all assets are transferred from the balance sheet of question except cash balance and bank balance. Gross value shall be transferred on debit side. Provisions will be transferred on credit side. This is in the question. It is given debtors less provision. So let debtors will balance 2,50,000, and out of that 5,000 was deducted, showing deduction in question, and this 5,000. So in debtors gross figure, here on the asset side you transfer the gross figure, and provision for bad debts, provision for doubtful debts, it is to be transferred on credit side. Provision this 5,000, and all these are liabilities 1 lakh. These informations, these asset and liabilities first we transfer. This is that way, and we can, and it is also said that the assets are to be closed by transferring them to realization account. These accounts are assets balance are closed. Similarly, outsider liabilities are also closed. Here bills payable is given in the question. Then now by selling of all these assets, amount realized will be recorded on credit side like this here, bank account, and all liabilities paid will be recorded on debit side, this here like this, a bank account here, this is the bank account. Liabilities paid here, bills payable 1 lakh, outstanding expenses only 10,000 is taken into account, realization expenses 12,000, it is given in the questions. Okay, so here I will show you these informations again. This land and building 4 lakh, plant and machinery 1,20,000, furniture 80,000, debtors realize 80% of book value. So this is the book value, 2,50,000 is the book value. 80% of 2,50,000, it is 2 lakh. Only 2 lakh rupees received from the debtors. And next, what is realization expenses on dissolutions? Here it is 12,000 amounted to, it was a certain, and Z becomes insolvent, and only 30% cash amount brought into business. Remaining 70% is capital loss, and partner X and partner Y will share this loss in their capital ratio. Okay, here is the questions. Again, we have seen this. Garner versus Murray principle is applicable. Now, what is the provisions or accounting treatment? I will explain you in respective place of Garner versus Murray. Okay, now you see the realization account just on credit side, and then just you have seen that land and building sold at rupees 4 lakh, plant and machinery 1,20,000, furniture 80,000, debtors 2 lakh. Now question is that here one entry loss on stock 10,000. Loss on stock is 10,000. This is to be understood with the help of this. You see here the value of stock is 80,000 and creditors had taken this stock at 70,000. This is given. A stock was taken over by creditors at an agreed price of rupees 70,000. That means there is a loss of 10,000, and it is so 80,000 stock, value of stock is 80,000, but creditors agreed to pay only 70,000. So there is a loss arising 10,000, and this is debited to realization account. Loss on realization, loss on stock. This 10,000 is loss of stock. Then this bills payable amount is silent in the question. So it means the whole amount paid 1 lakh rupees, and it is here 1 lakh rupees paid. And outstanding expenses, since it is from the outside of the balance sheet from adjustment, and only 10,000 amount paid to amount paid for outstanding expenses, this is the liabilities, and it is bank transactions recorded here. So journal entry, realization account debit to bank account, and this journal entry, realization account debit to bank account, and realization expenses, so realization account debit to bank account, and being realization expenses paid. So realization account debit to bank account, being outstanding expenses paid, journal entry. Total of debit side total is more than credit side total, and here the sum total is 11,52,000, and the difference is 2,47,000, the loss on realization, and this will be distributed among the partners in the ratio of 5:3:2, and it is given in the questions. Then the share of each partner X, Y, Z, this amount, loss on realization, transfer to partners capital account. Okay, so this is your realization account prepared. Partners capital account. So Garner versus Murray rule is to be focused here. For let us first, whatever entries informations given about the partners capital account, we transfer it. First, let us first transfer their balance given. Now again I will show you the questions. So if you see the X having capital balance 5,40,000, Y is having capital balance 3,60,000, credit side, and this is the liability side, so it will appear on credit side. Okay, liability side in the ledger, credit side. And Z's capital account having the asset side, then it is a debit balance, so it will appear on debit side, 1 lakh rupees. First let us transfer this. and thereafter the reserve balance is here 50,000. This will be distributed among the partners in the ratio of 5:3:2. It is given here, this one. Okay, so let's see here. By balance BD, X having 5,40,000, Y having 3,60,000, and Z having the debit balance. So Z's balance will appear on debit side. This is the debit side, 1 lakh. Alright, then realization loss, just we had calculated realization loss amount, that is a profit is transferred on credit side, loss is on debit side. This is the realization account loss, 1,23,500. So this is, so 1,23,500, 74,100, 49,400. This will be transferred to debit side. 1,23,500, 74,100, 49,400. Now Garner versus Murray rule, the solvent partner will bring cash amount equal to loss on realization. So it is given in the question, Z is insolvent, so Z will not bring, only X and Y are solvent partner. They will bring cash equal to loss on realization. This why, and this amount you have to write always on credit side, this here bank account. This is Garner versus Murray principle. Loss on realization amount, the solvent partners will bring in cash. 1,23,500 here, 1,23,500, and in here bank account. It means the partners, they should bring cash amount equal to loss on realization. This is the Garner versus Murray principle. And Y is the solvent partner, so 74,100 he will bring in cash. So writing on the credit side means the solvent partners has brought cash money into partnership business. And one more adjustment, 30 paise amount is realized from Z estate given in the question. So I will show you this 30 paise. This bank account you will find on credit column of Z, and this 41,820. This questions here, that transactions is written because of this adjustment. Here it is given, it was ascertained that Z become insolvent, paid 30 paise in a rupee or 30%, 30 paise or 30% was received from his estate. Because of this adjustment, the entry is recorded, and 41,820 is to be calculated after recording all the transactions. So these are, and one more reserve, I told you that reserve amount is given in the question, 50,000, and that will be distributed among partners including insolvent partners in the ratio of 5:3:2. So when 50,000 is divided in the ratio of 5:3:2, then 5/10 and 3/10 and 2/10. So X will get 5/10 of 50,000, Y will get 3/10 of 50,000, and Z will get 2/10 of 50,000. Then in this way, so X will get 25,000, Y will get 15,000, and Z will get 10,000. Entries relating to partner's capital account recorded. Now partner Z become insolvent. Now the second step of Garner versus Murray. First you balance the insolvent partner's capital account. So balancing. So insolvent partners is Z, and he has a debit balance amount more than credit balance amount. So debit balance having 1 lakh here and 1,49,400 total, and credit side is 10,000 only. So 1,39,400. The debit minus credit. 1 lakh balance 1,39,400. Now of this amount, Z will bring only 30%. Only 30% from will be or Z will bring only 30% of 1,39,400, 30%. So then if you calculate 30% of 1,39,400, so you will get 41,820. All right, understood? Then I will show you this working note. Now you see here the total of debit side of Z capital, just I told you this is 1,49,400, and credit side having only 10,000, 1,39,000, and he will bring only 30% of 1,39,400. This will be 41,820. So that means out of 1,39,400, he will pay only 41,820. So then remaining amount 70%, or this way balance, this 139,400 minus 41,820, balance amount is 97,580. Now this is the capital loss. This amount Z will not bring into partnership business. Now this is the capital loss, and this capital loss will be shared by X and Y. This is the Garner versus second principle. And now on what ratio? On their capital ratio. And how the capital is fluctuating capital? So then fluctuating capital is the ratio of capital is to be calculated as under. So opening balance of capital 5,40,000, 3,60,000. So this is for X, this is for Y. All right. So this is the ratio. And then reserve amount credited to X capital account 25 and Y capital account 15,000. Just I had showed you in the partner's capital account, and you add it. And loss on realization will not be adjusted. Ignore the loss on realization. You add it, so 5,65,000 and 3,75,000. And in this ratio, now this is the ratio. So then reduce this. For if you reduce this value, calculate the ratio, then so then this 3030, and then it will be only 565 is to 375. In this ratio, the loss amount shall be distributed. Here this 97,580. Now that is the total of this. If you total these two values, so you will get 940. So then X will get 565 divided by 940 in this ratio, 940 into 97,580. The amount, if you calculate the amount 940, you understood na? This one, this 565 plus 375 equal 940. If you calculate the amount 97,580, then X will bear the loss 58,652. This is way calculation. And Y will bear the loss 38,928 amount rupees. This. So this is the Garner versus Murray principle. So the debit balance of insolvent partners will be distributed between solvent partners in the capital ratio, and since the capital is fluctuating capital, so after adjusting all profit and loss account, reserve balance if any, and but before adjusting the loss on realization, the ratio which you get, on that ratio the amount debit balance of insolvent partners will be distributed. Alright, so I hope you have understood this working. Now let's go back to the solution. The amount alright, so I had shown you the working calculation and the amount. This is amount, how it is shared. This amount, how it is shared. This, it is 58,652 and 38,928. What is the journal entries recorded here? So Z's capital account is closed. So Z's capital account is closed, right? So then X is bearing the loss, Y is the bearing the loss. So then X capital account debit, Y's capital account debit to Z capital account. This is the journal entry. So in the Z capital account, X amount this and Y's amount bear the loss, and now they have lost this amount. They have the X and Y partners have shared the loss, then it will appear on their debit side of their capital account. Here this is. So writing Z's capital account, now X had bear 58,652 and Y had bear 38,928. So this one time credit side of insolvent partners column and second debit side of solvent partners capital column. This. Now total it. So solvent partners credit side is now total balancing of partners capital account, balancing of partners capital account. So X column first let us balance and then Y. So 5,40,000, 5,65,000, then total 6,88,500 and the credit side is greater. So 6,88,500 and the difference amount the partners X will take back from the partnership form. So here this amount 5,06,348 X will receive this amount. So journal entry will be X capital account debit to bank account, and similarly Y will receive the amount from the partnership form after the dissolution of the partnership form. So then similarly balance the Y's capital account 4,49,100, credit side is more than debit side, this 4,49,100 same this one, and the minus 74,100 minus this 38,928, the balance 3,36,072. This amount will be paid to Y, or Y will receive this amount from the partnership form on dissolution. So Z become insolvent, so his Z will not entitled to receive anything. No cash will be paid to Z because he is insolvent and he himself unable to bring his debit balance of capital amount. Alright, so this is how partners capital account is prepared. So Garner versus Murray rule principle is that the insolvent partners Z's debit balance of capital will be shared by solvent partners in the capital ratio, and it is this, and this is the fact. And loss on realization they will bring in cash. This is these two facts you always remember, Garner versus Murray principle. Okay, in partners capital account. So only partners capital account is adjusted. Next, now the amount paid to partners, now all cash transaction or bank transactions will be recorded through bank account. Now I will show you the bank account. This is the bank account. All cash coming, all cash going. from bank. All cash coming into bank, debit side. All cash going from bank, credit side. Now balance BD, cash at bank. It is given in the question. This is the cash at bank, 90,000. 90,000. So this amount will appear to balance BD, 90,000. Here, this is to balance BD. Then by realization of assets, total amount received is 8 lakhs. This 8 lakhs, you know that how it is calculated. This one you see that realization, land and building 4 lakh plus 1 lakh 20, 5 lakh 20 plus 80, 6 lakh, and debtors realize 2 lakh, 8 lakh. So this is the by selling of different assets 8 lakh rupees received, and it will be recorded on realizations account debit side, this 8 lakhs. And equal to loss on realization brought by partners X, this is 1,23,500. Similarly, partners Y brought equal to his share of loss on realization 74,100. And Z partners capital realize only 30%, that is the cash brought into business. Okay, so this is the 41,820. Then realization expenses paid, and in this 1,22,000, here realization expenses 12,000 paid. Okay, then credit, then bills payable paid 1 lakh rupees. Then outstanding expenses paid 10,000. So this total 1,22,000. And creditors balance is 1,50,000 in the given questions. Okay. So this one, creditors 1,50,000, and out of 1,50,000, stock value taken 70,000, as I already explained you, and the balance amount 80,000 is paid in cash. Okay, so balance amount 80,000 paid in cash, and this is recorded on credit side, this creditors account 1,80,000. And X capital account, they have taken 5,06,348, that is the bank account. It is shown on debit side of partners capital account. This amount I will show you here. This amount is, I am talking about this amount, 5,06,348, 3,36,072. This. And Y's loan account directly paid from bank account. This Y's loan account 85,000. It is given in the question. This is Y loan account 85,000. It is directly paid from bank account. Well, so I had explained you step by step, and to watch this till the end, like, subscribe and share with your friends. Thank you very much. Jai Hind.